So good morning, everyone. So let's begin the session while people keep getting added. I'm sure, looking at what has happened in the US markets overnight would have resulted in a lot of anxiety as to what happens in the Indian markets over the next week. And honestly, as of now, no one knows or understands how the tariff wars are impacted. All we can try and do is control or focus on what we can control. So what we'll try to do is first try to understand as to why we are where we are, what is the current status of the markets, and then of course, what is it that we can do looking at the next 12 months to 24 months of earnings season, and what are the sectors that we can focus on. So a lot of noise last week. Every one of us became a economist, became a gold expert, became a investment expert, and there's been panic of sorts in terms of how uh, a lot of retail investors I've spoken to, of course, at a time when we are trying to focus where we can find good valuation on equity side, people have trying to make mind on gold as well. So we'll cover gold at the end as to, does it, is it a good investment idea at this point of time? So quickly talking about what has happened over the last, say, 2 quarters. And these are the broad points that impact most of the global equities and especially Indian equities, whether it is dollar index, whether the US bond yields, the FII selling, the valuations, of course, and we'll focus on one impact, which the fundraise that has happened since post-COVID era. So now let's look at what happened to the dollar index, or what happened to our own currency. And whenever we've seen in the past, historically, when the dollar index moves up like this, and this is what we saw from October till somewhere mid-Feb, which also resulted in a huge depreciation for our own currency. So such a scenario, what it does is it leads to an impact where FIIs, as an investment class, so if they look at emerging markets and then they look at India, what happens is if they are looking to make something close to 10-12% CAGR, such sharp rally in the dollar index or such depreciation of the Indian currency, plus we also saw what happened to the US bond deal. It touched almost 5%. So in तीनों का impact ये होता है कि suddenly for FIIs, the rate of return, the CAGR that they see, falls down from 10% to 5%. And when the US bonds itself are giving you 5% kind of returns, why would India should be an investment destination at all? So from September, when the first signs of degrowth in growth, in most of, if you look before September, we saw solid growth across categories and sectors. September was the first quarter where we start seeing deceleration in this growth. So, and that is also the time when dollar index, USD INR, bond yield, these were the three key factors that started impacting the way FI started thinking about India as an asset class. And the moment these three together, plus crude, plus gold, everything fell in place for FIs to actually start selling massively. So in CY 25 alone, FIs sold close to 4 lakh crores. And this is purely because of they are also chasing returns. And if they see that after paying taxes, after a depreciating currency, if they're making only 5%, it doesn't mean that we should stay here. Now, also let's look at the entire valuation aspect. Whatever we may say in the short term, while liquidity is something that will be paramount when it comes to valuations or the kind of returns that you make. If there is no liquidity, we will see derating in valuation. We will see phases where there will be no returns. So liquidity is everything. So which is what we saw from 2021, 22, 23, the kind of domestic liquidity, especially the retail, HNI, the real middle class that started investing in India. So what they did, while they kept buying and, India was the largest growing economy, will be the largest growing economy for the next 5, 6 years. What it also did was stretch the valuations to a point, which we've not seen historically. If you see what happened to the Nifty 50 PE at the peak, last year it reached somewhere close to 25x, which is now corrected to somewhere close to 18, 19x, which is the median. But look at what happened to the small cap and mid cap P's. And this is largely driven by the retail and HNI and large part of the middle class population who pumped in a lot of money into small and mid cap companies. Now, this P moved from, say, close to 15x in 2020 and reached a peak of 46x. And, while a lot of us are believing that, most stocks median level in small and mid cap are down by 40, 50% or even maybe more. In spite of this correction, we still trade at 32 times P. And just because we see it relative to 46 times, it might look cheaper. But if you look at the historical average, which is close to 1920, we are still much overvalued. This is where, market needed a reason to fall. As I discussed, the bond deals, the dollar index, the USD INR depreciation, the FI selling, all this plus slowing growth became the reason for this to drop dramatically. And, the market cap to GDP ratio, while in the short term, we've seen historically, it has never failed. And we reached close to 150% end of December, which is now corrected to 116%. While the median has been 71% historically, I still believe that closer to 90% is when, or 100, closer to 100% is when a lot of value emerges. So we are still not in the value range for the overall market. There'll be select companies, select sectors where we have a much better visibility. But overall, if you see, this still remains a big challenge in terms of, where this settles. And coming to, this is a very important aspect, the result of, or, what is the output of this, we will discuss in the following segment. So over the last 4 years, 5 years, we've seen close to 4.5 lakh crores or 5 lakh crores kind of fundraise, which has happened. 60 to 70% of it was OFS, which went to the promoters. And the balance was used for capital expenditure and working capital. Now, this is just on the listed part. My sense is there'll be another 20% of this amount, which would be close to 1.5 lakh crore, which went in the unlisted equity market. So, and that was largely, this was purely for the capex purpose. So over the last 5 years, close to 2.5 lakh crores or 3 lakh crores worth is something that was raised purely for capex and working capital purpose. Now coming to the present, I think so these are the things that we are worrying about today, and I think the biggest worry today is the tariff. Uh, Today Trump has tried to bring everyone on the table today, to discuss how whichever country is charging them higher duties, how they can get that down. And it's a casino royale of sorts. If you watch this movie, and I know they are playing the game of poker, so everyone is trying to have a straight face while still trying to guess what the other party is going to do. So I think as of today, while the effect has been too quick, you saw what happened to Dow on Friday and on Thursday. This still remains the unpredictable part, or the part where the volatility will continue to remain. It is not going away in a hurry. I think as the negotiations begin, and this could take up to 2 months, 3 months, 6 months. It becomes very difficult to understand what happens on the tariff piece, and we'll discuss what are the sectors that get impacted, and then we'll of course talk about what happens when we see a little degrowth, or deceleration in growth in most of the segments, whether it is large, mid, or small. And if that happens, what happens to the P's of most of the sectors or companies? And then, of course, we want to also talk about, while these are all negatives, as a country, and as we look forward for the next, 3 years or maybe 5 years, what are the positives that have been derived over because of what has happened in the past 5 years? And of course, we unless and until there is a strong capex cycle, we don't see the growth coming back. We'll discuss that as well. So now I'll try to keep it simple actually. We may talk about a lot in terms of what tariffs Trump will believe, Trump is bringing. So the single largest sector, if you see, is IT exports. Now that is something that has been relatively untouched. Close to $200 billion of exports of IT. From that, $100 billion is what we export to the US, which is like 870,000 crores. But while there is no direct, tariffs on this segment, we have to consider that if, with the kind of whatever Trump has been trying to do, if US goes into a recession, we'll see a massive demand slowdown in companies, corporates, and that eventually leads to a slowdown in the IT budgets. So the Indian IT sector is a direct, what do you say, will be the largest impacted one if whether it's a hard landing, soft landing, it's very clear that US will go through its own challenges in terms of growth. And if that happens, IT services will be the most impacted, even though there are no direct tariffs that have been levied. Now, the other sectors that we see, I think, so if you look at the charts, you will be able to see clearly what has been happening. And according to me, pharma sector is one sector that, there was a lot of worry about, first in the first set of tariffs, there was nothing mentioned on the pharma space. And if you look, close to 30,000, 40,000 crores of pharma products is what we export to the US. Now, what we import from the US, we charge close to 10% duties. So the differential honestly is not that big. So this is one sector I still believe that will be relatively untouched, while Trump has mentioned that, we'll have a different set of duties for this sector or the semiconductor sector. So of course, because of the volatility, because of the uncertainty, we'll still see a lot of moves, but there's still a lot of pharma companies that do not derive a large part of their revenues from US. So we'll also have to track these down. But this will still be relatively sector where the duties will be much lower, or it will be very easy for us to say that, this is what we remove these 10% duties. The deficit that has been derived from this sector, will let it go, and, it will continue as usual. The other large sector is gems and jewelry. If you see, we export close to 80,000 crores of worth to the US. And, the tariff that we charge them is pretty high there. So this will be one sector apart from agri. If you look, will be a sector where, the tariff that we charge to US agri products that we import is close to 39%, which is where I believe they will be largely impacted. And two other sectors that we should discuss. One, of course, is textile sector. We export close to 90,000 crores worth of products to the US, and hardly any imports from there on this piece. And so this is one segment where we believe that it will all be relative. What are the duties that we are seeing to happen to, competitive countries like Vietnam and Cambodia and Bangladesh? My sense is most of them will have already approached the US government saying, we'll get to a zero duty or tariff regime within their own country so that, they can be spared. So uh, I think this will be clear only over the next 3 months whether, what is the incremental tariff that will be levied on the Indian textile and apparel sector, knitted, non-knitted. If you see, add up all together, it's close to 90,000 crores. So again, not very clear how post negotiation, how competitive will we be? What is how we conduct our own negotiations? Another large sector is auto. Uh, we impose almost 150% duties on vehicles that come in from the US. And what happens is this is where, you know, whether Tesla might be lobbying or there'll be other automobile companies that will be lobbying. So this, in terms of listed companies where autos or auto components will be the ones where you'll see maximum impact. We saw what happened to Garware High Tech. We'll see what happens to Sona or a lot of, say, GNA Axles or a lot of companies which derive a large chunk in terms of the component business. Uh, and that will be hit apart from, Tata Motors, which derives close to 25% of their revenues from that particular space. So these are the sectors where I'll try and stay away for now, till more clarity emerges in terms of which segments or where post negotiation we still have an edge. This is purely discussing, what is the tariff differential, and we'll see that maximum has been with electrical machinery, gems, jewelry, and pharma products, which is where I think the uncertainty will continue. So we'll have to be very careful about, trying to find a bottom in these sectors. We saw what happened to Goldiam, or we'll see, there are not a lot of gems and jewelry companies that are listed, but in terms of listing impact, pharma, auto components, machinery will be the sectors that we'll have to watch out for. Now, coming to the earnings piece, as I said, if we stay away from all the noise, one segment that will clearly be like, we'll have to see what happens to valuations when earnings growth comes down. And historically, if you look over the last decade, last 5 years, last 15 years, last 20 years of earnings CAGR on, say, the benchmark Nifty 50, if it has been in the range of 11-12%, the returns also has mirrored exactly what the earnings growth has happened. We've read about this multiple times in the past, and this is something which fundamentally doesn't change. Whether it is re-rating, de-rating, over a longer period of time, your returns will always and always mirror the earnings growth. And if we look at what has happened, in terms of earnings growth, I think it is very clear that, of course, we saw some kind of softness in September, but December it was uh, more and more pronounced. So, because the GDP growth came in at 5.4% in Q2 and then again 6.5% in Q3, we saw net GST collection growing only modestly in that quarter of, just 3.3%, which is back to 10% now. All that led to across the board degrowth. Now, what happens when, the revenue growth slows down? And so if you just look at a 4% degrowth in earnings on the Nifty 50 led to a correction of Nifty from, say, 26,000 to 22,000, which is close to 15%. But at the same time, the P is corrected by close to 21%. So a 4% correction on Nifty 50 results in a P derating of close to 20%. So if you look at Nifty 500, a 7.5% of EPS decline on a TTM basis led to a P derating of close to 20-25%. Now, what do you think will happen to the small cap index? So if the earnings growth, comes, if you say, the earnings, TTM earnings degrowth that we'll see, if it declines to 10% or 12%, the actual derating of P's on the small cap can be as high as 30 to 40%, which is what we've seen over the last 2 to 3 months. And uh, it was a great 4-year run. And, where it was a classic case of, flows chasing growth, but, flows don't cause growth. And we saw a massive 10x jump in small cap assets of active equity funds from 2020. So when the first degrowth cycle starts and it lasts for close to 4 to 6 quarters, and we've seen 2 quarters of that degrowth already, and I think Q4 and Q1 won't be very different in terms of growth. So this is one piece where I believe we have to be very careful. Renewables has been a classic case where the P's got re-rated from 10x to 50x, and they are now getting derated from, say, 50x to 15x. So if we get stuck, if there is earnings degrowth, if you are in a small cap, mid cap category, the P derating will be so severe that even though, before you could react, you would think that, growth has come down from say 30% to 20%. It is still higher than what the large caps are growing at. But the P derating is pretty severe. So you have to be pretty careful about this aspect as well. Now, coming to the good part. Now, when we talk about the kind of money that was raised over the past, you know, uh, 4 years, 5 years, the good part is that if you see, the debt to assets ratio is at a 17 to 18-year low of 19%. What does that mean? It means that thanks to equity, all assets that were created over the past few years were created with very low levels of debt. And the corporate balance sheet are at their strongest ever and can withstand and really withstand any down cycle that will come. The pain will be there, but it will not be what happened in 2008, where, or maybe even 2018. The corporate balance sheets are very strong. And what happens is that, coming back to this, so if you look at this slide and then see what happens here. So we've raised close to 4.2 lakh crores. Sorry, yeah, 4.2 lakh crores. And that if you look at the OFS part and the capex part plus the unlisted part, so close to 3 lakh crores of capex and working capital needs have been met by the equity markets. Now, most of that capex went, in terms of, when you start building this, it takes usually a period of 18 to 24 months. And if that 18 to 24-month period, if you consider, which ends anywhere between second half of 26 and 27. So what happens is, if all this capex is coming online, and we'll see that growth for most of these companies getting built in the second half of 26 and 27. So suddenly, as we come closer to the Q2 results FY26, after that, most people start looking at the 27 numbers. We'll see that a lot of companies will be available at sub 15p, sub 12p, sub 10p, or whatever the valuation matrix, depending on sectors, while the growth could be as high as 30% for the next 2 to 3 years, which is where we will get some real investment ideas and bets. So in the next 2 quarters, will completely define or segregate, when the common saying men versus boys, etc. So that will be a clear demarcation over the next 2 weeks, which we'll see the next 2 quarters, and those 2 quarter results will show us which are the sectors which are not as prone to growth versus the rest. And we will talk about the sectors that we think will do far better than most others. And so coming to the future, what should we do? Of course, stay away from all the noise. It's very difficult for us to understand the first order, second order, third order impacts of these tariffs. And we also shouldn't rush into, buy or buying the dip. You'll hear a lot of investors trying to, basically believing that, we are buying something at 12x 1 year forward. But you have to realize that if there's no P re-rating, we might stay at 12x for the next 1 2 years. So all the anticipation that we had built over the last 4 years, whenever we were also investing, we've never bought anything more than 15x forward P, even in the peak of the markets. And we were very clear, we will say exit at 30x P. I'm just talking about very broad rule of thumb. But what has happened is that itself, we will have to tame down our expectation dramatically. So today we say we'll not buy anything at 10, 12x, and we'll have to look at exiting at close to 20, 22x. So this massive discount to the exit multiple is something also that we need to consider. So now every investor should have their own framework which suits their own personality, own character, own style, and not rely on what you hear on a lot of channels. Incrementally we'll have to be more thoughtful about where we invest, as while most of you would be investing on your own, or investing via small case, investing via small or large PMSs, or rather mutual funds as well. I think the basic framework that one needs to consider if you're going into a small cap, mid cap fund, Be, whether it's a mutual fund, uh, be mindful that, if it is a very, very large fund, it's very difficult to get that alpha. The smaller funds would be far more nimble and, uh, far better to position themselves in terms of pivoting to sectors where they'll see growth. And also for your own framework, be careful about what is uh, the visibility of next 4 quarters is extremely important. While we keep talking about long term and long term, I think in times like these, long term is, even 2 to 3 years is too far. We have to make sure that we don't lose our capital over the next 2 quarters and focus on adding companies where we have very clear visibility of growth and performance for the next 4 to 6 quarters. So the key sectors, of course, then become, जैसे कहते हैं घर की मुर्गी दाल बराबर. So we'll have to focus on sectors which are largely domestic focused, where the demand is largely domestic. And we'll quickly discuss 3 to 4 themes. Unfortunately, we would also like to take questions, so we'll try to run through these themes in the next 10 to 15 minutes. So let's look at 2, 3 themes. So let's start with value retail and premiumization. This is just a basic chart. If you understand, it's good. Otherwise, the basic way to understand this is that, you know, uh, over the last 3 to 4 years, the the middle class, and this is the evolution of household income we've seen, and see what has happened from 2005 to what will happen towards 2030. We'll see this young, savvy, poor dreamers, or the middle India, aspirational middle India. The Earlier we used to talk about the pyramid. Today we'll see a ballooning middle part of this, rising middle class, which is where a large part of premiumization, value retail formats will do extremely, extremely well. And you don't need a lot of rocket science to see why this is happening. While, a lot of things are happening globally, if we ignore that, our own population is enough to consume this kind of, and, the aspirational move we've always seen. But, what happens when a country reaches a very critical point in, say, per capita GDP? And we've seen, we've done a very detailed work, and I've discussed this in a few videos of ours as well, that whenever a country moves from $4 to $10 trillion, at $4 trillion, we were largely focused on, say, roti, kapda, makan, the basic needs, and maybe even medicines. Now, as we move from $4 trillion towards $10 trillion over the next decade, uh, you know, the aspirational part of the population will come into play. So, whether it is from wearing a Timex, moving from a Timex to, say a Rolex, or moving from a Bata to a Hush Puppies, or moving from Oyo Room to a Lemon Tree, or, a lot of these themes will eventually play out. And, when we talk about penetration of most of these categories, we are still far, far, far lower than we compare to, the only comparable actually would be China. So, whether it is two-wheelers, whether it is cars, whether it is refrigerators, these categories is something that we believe will continue to grow at a decent 15-20% kind of CAGR growth. Now look at, just let's take a look at the China piece. When China moved from $4 trillion to $10 trillion, which was between 2007 to 2015, look at the category growths. And if you see cosmetics 22%, jewelry industry 30%, luxury vehicle sales 30%, online shopping 70% CAGR growth for that entire period. Luxury goods, real estate, high-end hotels, brands. So all these segments will do extremely, extremely well over the next decade. And I don't see a reason why we will not see similar kinds of growth, because, looking at where we are in the global picture, I think India will continue to remain the fastest growing economy over the next 4 to 5 years, at least till 2030 and beyond as well. So what are we trying to buy within these segments? Of course, the first aspect is moving from unorganized to organized. So, you see a lot of retail store format stores like Trent, like the Zudio stores, V2 retail. We've seen, the way it has grown over the last 6, 8 quarters. There's V-Mart, there's Style Bazaar, you know, people moving from traditional jewelers to Titan. Here, if you want to play an ancillary, there'll be Sky Gold that will now, I'm taking a lot of names. We might have investments in some of these names. So just a disclaimer. This is purely just to explain you in terms of giving you a context. So don't treat this as investment advice. This is just for your understanding and reference. So one, we will see a large movement from unorganized to organized. The second aspect will be moving towards mix improvement. So say within the own segments, they'll try to have more branded, more own brands, or you move from say a red label to black label. As I said, the aspirational value, you move from 32-inch TV sets to 48-inch, you move from Oyo to, the luxury positioning. So from 3-star hotels, you start spending on 5-star. And we ourselves have seen, if you look at how you used to, your own purchases over the last 5 years, you see how you've been spending. In terms of the brands that used to wear 5-7 years ago, and what the kind of brands that the integration would have been slow, but it is clearly visible. From going to a small clinic, we would want to be treated in a Max or Apollo, the best hospitals as well. So when I say premiumization, it will be across formats. So, these are the companies or stocks or, themes that you should look at. Again, purely representative purpose, whether it is a B2 retail or a Style Bazaar or a Ethos. If you look at the Alcobev sector, Sky Gold within jewelry, Dixon Amber PGL have been, the pioneers of, manufacturing in India. So I think these will be the segments. And again, these sectors, see these sectors. So largely we have to focus on such themes where if we can find something at a reasonable value in this correction, I think this is something that will make you a good return, and returns will mirror this kind of growth, which will be say 25-30% if we see some categories growing. I am sure that returns will mirror, and sometimes if we see P rating advantage, it could be higher as well. Now coming to the second theme, again a very purely domestic theme, transmission and distribution theme, and this was one of our key reasons to be so bullish on renewables as well, and I think they will continue to do well. And so if you look at the sectors, uh, you know while this is purely academic purpose, and if you look at the peak power demand and supply, I think over the next few years we'll see a massive change in terms of how you could see the growth in peak demand. While the government estimates close to 6%, my sense is purely because of this huge capex push that is coming from government, which will remain flat, but it will be there, plus the private capex that has been happening over the last 2-3 years and will continue for the next 2-3. I think the power demand could actually grow at 8 to 10%. And if you see earlier, I know because we were largely focused on traditional thermal and maybe wind and other segments, the entire network was largely east driven, near conventional energy sources. But if you look at going forward, the more than 220 kV lines will be added on the western belt of the country, where 60% of renewable energy is there. Plus, because the large, incremental power demand is being met by uh, renewables, and whatever thermal capacity will also come, because it is largely on the western side, you'll see a huge growth in the transmission and distribution network within this side of the country. And so this is what we see, the transmission line addition to be in the next 6 years, it will grow. While my sense is that we've been falling short of this addition in a big way, and we need to pull up our socks as a country to meet this even 6% kind of demand. So currently, say we are doing at 14-15,000 installation, what we require is double of that, and which is where a large part of focus will be from the government as well. And this is the transformation capacity that is coming in the country over the next 6 years. Close to 12% CAGR is what we'll see over the next 5 years. And current installation is close to 70-80 GVA since last 3 years. We need almost double of this as well. And I think this provides a lot of opportunity within the transformer space, within the transformer and distribution EPC space. If you look at this, the transmission capex, which is going to happen, uh, was 9.2 lakhs crores, of which we see that 4.5 lakh crores will happen over the next, with 20 to 27 period. So we've seen another 2.5 lakh, 3 lakh crores will happen over the next 3, 4 years. And then another 5 lakh crores from 27 to 32. And if we, look at each kind of capacity, again, it is purely technical. You can just refer it. Idea is to show you the large picture where, what are the sectors or where we believe there'll be a huge impetus in terms of government and companies. So, these are the companies that we believe will do extremely, extremely well. Again, these are a few names that we've been studying, and we believe that from across regions, whether it is Transrail, Rajesh Power, again, whether it is you're into electrical transmission and distribution EPC, or you're into manufacturing of key equipment within this space, I think all these companies will do well. Again, valuation will play a very important part, and you have to realize this is a cyclical sector. So very important as to what is the entry multiple that we'll see. The third theme that I believe that, will again largely domestic focused, and where the focus will continue to remain from the government is this. Now, water, if you see, water is just not, wastewater treatment. There'll be effluent treatment, municipal, industrial. So there are a lot of segments that within water that we are seeing, and whether it is, the river cleaning or the Jal Jeevan Mission, Har Nal Se Jal. I think the investments in these segments will continue, and largely, if you see, these are the treatment capacities and what we require. We are almost 50% under capacity in these sectors. And I think even if we grow at 20-25% CAGR, it will take us a lot of time to get into a situation where supply meets demand. And of course, there are a lot of different problems that government has in terms of, groundwater levels, urbanization, industrialization. These are things that we already know. So if you look at, sewage treatment, water treatment, effluent treatment, these are the companies that have been pioneer in terms of, if you look, we've broadly classified them as to, who does what. And if you look at this chart, you'll get a fair idea who's present at what point of the value chain. And based on that, we'll have to do our own work. We are studying most of these and hold also a couple of them. So whether it is, someone like a Josh Engineering who is into manufacturing key products that are required for effluent treatment, whether it is Ramki Infra or Wabag, who are primary, in terms of the EPC part, or Synthesis Tech, which is into the geospatial piece, where, if you look at before the elections, including municipal, state, and center, we were seeing close to 1 lakh of, orders within the water segment every month. And every tender that comes out, it needs to, have a geospatial mapping done, which is where Synthesis Tech comes into place. Apart from, of course, there are other businesses that they do. But considering we are considering water, and incrementally 70% of the order book is coming from water, this is something that will see a huge amount of growth over the next 2, 3 years. And coming to the last theme, now manufacturing, even though we believe that, we will continue to build our expertise into a lot of sectors of manufacturing. I think the recent tariffs, and we saw that, one of the largest sectors in terms of machine, electricals and equipment within this is something which we export a lot to the US. I think it is very important what part of manufacturing piece you're playing. Now, again, broader picture. We had showed this chart when we had done this manufacturing session as well. And, my sense is government is very clear. They want to move manufacturing from a 17% GDP to 25% GDP. And whenever we've seen this in, say, countries like China or Indonesia or, Thailand, the growth within that sector has been tremendous. If you see, the 2007 to 2015 phase, where US moved from $4 trillion to $10 trillion, or the 1985 to 2015 years channel where US moved from $4 trillion to $10 trillion. Manufacturing was a very essential piece within that segment, which grew close to anywhere between 15 to 25%, and the companies therefore the returns were far higher than most of the other sectors. So we believe, of course, and this India's time has come has been true for the last 3 years as well. We are building up, we are creating opportunities, we are building capabilities, and government itself is providing a very favorable environment, whether it is PLI schemes, whether it is giving a lot of subsidies and a lot of land in terms of, for high growth sectors. Government has been very open about, why we want to build these capabilities. So when all the three pieces are coming together, I think for the next 5-7 years, we'll continue to see a lot of advances in manufacturing as well. So again, domestic consumption, import substitution, which we saw in defense, or export promotion, which is, if you look at what has happened to the mobile phones that we export, or a lot of these, branded companies or branded sectors like, consumer durables, discretionary, which is where we've been, or textiles for that matter. So again, there'll be a gray area between, just a sec. I don't know why these two lines are appearing on each of the charts. Okay, now the last chart. I think last 3-4 months, I think last 1 year, gold has been the best performing asset class, giving close to 30-35% kind of returns. Such volatility only increases, the use case for gold as an investment. What we need to understand is that like all asset classes, gold also is a very cyclical asset class. If you look from April 89 to December 4, there was zero growth in gold. We saw a similar phase from 2013 till 1920 as well. So I think your portfolio needs to be very focused on, in terms of when you have equities, where you'll have debt, where you'll have gold. Gold will play a role in the asset class formation, but it cannot form like a 25-50% kind of investment, asset class within your portfolio. So of course, as I said, gold is cyclical. If US goes into a recession, if there's a lot of global uncertainty, and but my sense is this will all clear out over the next 1-2 years, which is when gold as an asset class suddenly will start underperforming for the next 3 to 5 years. So if you cannot time the entry and exit, I think it is very important that have it as a small percentage of your asset. So this is all. I think we are in uncertain times, and it's very important that we again come back to focusing on fundamentals, focus on what are the sectors which will be shielded from this global madness that is happening at present. It is very easy to get overwhelmed in such a market scenario, looking at 500 falls on the Nifty, and maybe 1500, 2000 kind of fall on the Sensex. And when it happens continuously, it hinders our capacity to think, capacity to act, and capacity to work. But this is the best time to rebuild, the opportunity to exit from a lot of fringe positions and start building. In a bull market, you will have, say, 50 stocks in a portfolio, but in a market where the growth is uncertain, it is very important that we reduce the number of companies that we own and hold on to companies where we see reasonable growth versus the rest, where the margin of safety, where the visibility for the next 4-6 quarters is good. So so this is all on the macro side. So sure, if you could just quickly, I'll go through the questions that have been put up in the chat box. Pushparaj mentioned how is mid cap and small cap thematic position in terms of US tariff. Have you any plans? So of course, now that all the cards have been laid on the table, it will be very easy to pivot for us. I think Q4 and Q1 will be the key quarters where we'll be tracking more than 1,500 companies, which is where the entire portfolio will be pivoting to companies, which the themes that we mentioned, and plus the themes that we believe that will have a good visibility over the next 4 to 6 quarters. And someone mentioned, Darshit mentioned that there's been no major stock addition in the small case. So we started, say, small case in May, June last year. And since then, we've not found a lot of investment ideas in terms of, when we say blind buys, no brainers. So we've held on to the companies which we understand well. Of course, we've seen PD rating in a lot of these stocks in line with what has happened with the market. But my sense is once we pivot from this portfolio, and this is post Q4 results will be a great time to rebalance most of our portfolios as well, which is when we'll do it. Someone mentioned on Krishka scrapping uh, that you had several interviews with their promos and any tariff impact on metals. I think 99% of Krishka scrapping business is domestic. They have done a great job in terms of transforming themselves from a pure stopping business to the pure product company, and the result of which will be very evident over the next 2 3 years. Again, this is one where we'll have to have a lot of patience. Uh, then let's look at Deepak Agarwal's question. Solar manufacturing sector, as solar installations are going to follow a J curve, how do you vary specifically in the current situation? So see, we saw a mad euphoria on the renewable space last year, especially in the second half, which is when we also stayed away from investing in a lot of unlisted solar companies. We have been in this space for more than 3 years now, and we realized that the valuation, the frenzy that we saw, although the opportunity remains, nothing has happened to the opportunity. I think government is hell bent on improving, making this sector as one of the largest in terms of the power sector in India. And we will see that J curve growth in the next 3 to 4 years. The companies that will do well, the commodity companies will remain commodity companies. But when we see Wari or companies which will move forward towards backward integrate towards uh, cell manufacturing, will be the companies which will demand valuation. If you see the sector, you know, if 100 rupees of profitability is generated from the sector, uh, 45 rupees will be towards module cell manufacturers, 45 rupees will be towards EPC players, 10 rupees will be with all the ancillary companies. What happens in module and cell manufacturers is that the top players, I'm saying top players means top 5 players, will control the giant share of the profit pool. While in EPC, the profit will be fair, the pool will be fairly distributed. So if you see, there is large return to be made with, say, cell manufacturers versus EPC guys. But EPC guys will give you a benefit of lower volatility, because irrespective of which module guy, which cell manufacturer does well, EPC players will not have a bearing on who does well. They are like a ancillary play, which even if the top category is doing well, and whoever does well, they'll provide it to them. So you'll have to have a mix of both within your portfolio. Can you share upcoming themes like data center and green hydrogen? I think, unfortunately, there are not a lot of investable ideas within these segments, but I strongly believe that there's a recent report. We mentioned that by 2026, the data centers in the world will consume more energy than a country like Japan. By 2030, the land required for all the public data centers in the world will be larger than Singapore. And there's massive growth happening within this sector. You'll see that happening in India as well. And again, this is a common discussed thought that while we consume close to 20-25% of the world's data, the data that is present on Indian shores is less than 2-3%. So all government is very clear that we need to bring all that back. So whether it is data centers, cyber security, these are the two sectors which will see massive growth over the next decade, especially in the next 3 to 5 years. We are on the lookout for companies, whether it is data center EPC companies or pure data center plays, which will come in. Unfortunately, not a lot of listed opportunities here. We have been invested in few unlisted companies within this space, data centers or battery. And the other sector mentioned was green hydrogen use case is still 2-3 years away. And while a lot of hue and cry, or a lot of rush was there to find these kind of companies. I still believe that uh, only 2 to 4 players will emerge from this, and whoever emerges in terms of having the right technology, having the right pricing, and eventually reaching the end consumer in a way that becomes feasible for them to replace gray hydrogen, pink hydrogen, by green hydrogen. I think let's stay away from most companies that try to say green hydrogen. Even for that matter, AI is one space that we are extremely, extremely bullish on. We are putting in a lot of work to understand a lot of aspects within AI. And post our meetings with a lot of AI companies, we realize that this will be one sector that will grow at breakneck speed. Transformation that we've not seen over the past 2 decades will happen in a year or two. And uh, the challenge is that even a great AI company can become irrelevant overnight. So again, this is not a sector that most retail investors should invest in unless they can track their investment day in, day out, track the technologies that are changing, track the advances that are happening within this sector. So I will again request everyone to refrain from this, because everyone wants to be called an AI company. In uh, totality or in reality, uh, most of these AI companies are, how a BPO is to a large scale IT consultant job. These are, very smaller services that Indian companies are providing. We still have a lot of options within the US to invest in, but in India, stay away from anyone who calls themselves AI or, green hydrogen, or even data center for that matter. Anand Raj calls himself a data center company, but we've seen what has happened. You know, they are a real estate company. So, then I believe Karthik has mentioned, I believe you continue to remain bullish on defense and aerospace sector. So I think the defense exports, defense as a sector will make a comeback. The only challenge here is valuations. And the only reason we stayed away from this sector for the past 12 to 24 months has been valuations. And uh, we will continue to remain away as far as, something which we believe is available at a valuation where the downside risk is 20% and upside is 100%. We will not put it into the both these sectors, because they are again very, very richly valued. Any other questions? If you want to raise hand, ask directly. We are open to taking these questions. I'm just trying to go up and see.
Hello.
Yes.
Hello, Piyush sir. Very insightful presentation. So my question is on the commodities fund. So we have seen a big cut in lot of commodities, say copper, cocoa, even palm oil. So are you guys starting to look at sectors like snacks where uh, palm oil prices were um, uh, contacting their margins a lot? So what are
So,
your views on your commodities that have been falling, and your any strategies that you guys are playing up?
so commodity is one sector that we've stayed away for the past 5 years. This is something that is beyond our understanding. We are not someone who can, play these cyclicals or, anticipate how, because what happens is commodities, largely these are globally driven commodities. And it's very difficult for us as a team to, continuously monitor what is happening in China, what is happening in Australia, what is happening in Brazil, Africa, or the US, or the Saudi when you talk about crude as a commodity. So, this is beyond our own, understanding as to why these cycles play out the way they do. What we try to actually do is whenever there is a commodity, turnaround in certain sectors like say metals or, other sectors like oil. And if we have an ancillary play that we can play it, which has a far better, uh, hang on in terms of, how they can pass on the volatility to their customers. I think then we try to identify these ideas. But pure play commodity plays, we've always stayed away. We've always stayed away from public sector companies or public sectors where government intervention can come in anytime, like Mahanagar Gas, LPG gas kind of sectors. We've stayed away. We've never invested substantially. When I mean substantially, never put more than 4-5% of our portfolio ever in financials, because again, this is one sector that it's very difficult for us to understand. because they are lending to, one bad account. We've seen in multiple cycles, one bad account, what happens to the multiples of that particular bank or that entire sector. So these are the sectors that we've stayed away. These are the sectors which we believe for us are also very difficult to understand.
And so, what about say a snacks industry, BKG or
No, so
something like that?
so see, so far we've not. Sorry, Mukesh, you are. Yeah, she's sorry. What were you saying?
Sir, ask him about the maybe snacks industries where the raw material is a commodity like palm oil, and where the price uh, volatility was not so common. So the last hike that the palm oil prices have seen is a very rare thing in the last 20-25 years, and the cut that's happening may expand their margins again. So
Honestly, we have
any
not looked at this sector, but since you've highlighted this, thank you for doing that. I'll have my team, evaluate if there is some serious, basically, the raw material price crashing, and in terms of growth, if they are growing at a space that, fits our framework, we'll definitely look at those sectors. And if we find something interesting or worth investing, we'll definitely post it on our social media handles as well. Thank you for highlighting it. We haven't looked at it.
thank you, sir.
Sandeep Manad asked a question. What's your view on railway wagon companies considering scope for Vande Bharat, freight corridors, metro, etc. in the future? I think this was a sector with a lot of promise over the past 2-3 years. Unfortunately, the tenders came in, some were cancelled, uh, and despite of that, the government didn't pick up a lot of stuff from these wagon companies. Even if they did, the payment cycle, which used to be, and again, this is from a few investors on the private side who supply to these companies, like supply to railways as a client. The working capital cycle changed from 15 days to close to 150 days, 300 days. So, if the payment cycle, or this is something where most of the companies which supply to the government side, if your working capital cycle is something which becomes unmanageable and the cash flows then get impacted, I think the valuations derate really fast, and we've seen that in most of these companies. And while the opportunity is huge, uh, we need to see on ground change in the way government is paying. Ankur is asking, what's your view on pure play water pumping companies like Shakti Pumps? Are the valuation of 30p justifiable? Uh, Ankur, actually, Shakti Pumps is not available at 30 time. Maybe on a TTM basis, it could be. But based on our earnings matrix, I think it will be available today at less than 20 times 1 year forward, where the growth should be rather higher than 30% CAGR for the next 2 to 3 years. So while we were early investors in Shakti, we still believe that even from current pricing, we'll see a strong, like it will beat our own estimates. Uh, and the only thing to worry about here again is how they are managing their working capital cycle. So I don't think Shakti is at 30p. If it was 30p, we would have exited yesterday. And I think it's still trading at close to 18 times 1 year forward and close to 14, 15 times FY27. My sense is that this will, on a TTM basis, will trade at 25 times. So that is where the opportunity is. Prince from Pink, the data you shared for consumption is known to most investors, analysts who are tracking the sector. Yes, we saw growth in few spaces such as tier 2 retail. The names you shared are even premium alcoholic beverages. My concern is, why don't we see rapid growth in consumption across QSR or other spaces? Are we missing something? So I think QSR as a category is hugely fragmented, according to me. Uh, Whether it is a McDonald's or a Pizza Hut, I think even if you look at your own consumption choice, Uh, how many times do you consume a Pizza Hut, Domino's, McDonald's in the entire year? And there are always new restaurants coming up, and we as consumers are open to trying these new choices. And most of these upcoming ones will not even be listed. So QSR, we've always stayed away. We've always believed it is so fragmented and the unorganized space is so large that making money sustainably over a longer period or showing that kind of SSG growth over a sustainable period is extremely, extremely difficult. And the reason to show this data again and again and again is that when markets correct, it is important to look at the macro picture. Sometimes we fail to do that. We get very anxious or worried about what is going to happen. And this data gives us a macro picture as to that as a country, when we compare ourselves to China at $4 trillion, these sectors will do extremely well. And where especially tier two, tier three, tier four, where the larger part of because of online delivery and more exposure via everyone has a phone network, everyone has access to Instagram, everyone has access to most of these social media upcoming trends. And because of that, my sense is that if again, it's not that likes of V2 retail, Style Bazaar, V-Mart, that these segments are not fragmented. But what is happening is the growth is not just coming from the aspirational part, but also from a lot of shift from unorganized to organized. And V2 retail is a classic case which you should study what happened and you should study the last 5, 7 years. And you will understand how they kept pivoting. If you look at what happened to them 3, 4 years ago, you would not even touch it. But the way they pivoted changed a lot of their own metrics within the company, which meets the consumer demand or their own growth patterns. I think a lot of companies which are doing this pivot purely focusing on the consumer taste, and luckily we have few names that are growing well and we can participate. So even though this information is known, it is very important to look at it in times of uncertainty because that gives us confidence that if we are moving from a $4 to $10 trillion economy, there is no other choice but these sectors to do well. Even Alcobev, for a matter of choice, we'll see that kind of growth in most of these premium alcoholic beverages companies. And the only question is your entry multiple in most of these, which were very, very, what do you say, exaggerated over the past 12 to 18 months. And the reason to mention again now is that valuations are now becoming more and more, tenable. And it's very important that once you get the entry multiple right, I think exit will take care of itself. It's again a different session altogether how to exit. But at least your principal is safe at that, relatively safe. And what is your view on nutraceutical companies? We've stayed away from, again, this sector, even pharma as a space. Just last 3, 4 months, a lot of people pushed us to look at CDMO. And it is becoming very difficult for us to monitor so many things. Uh, and there are people who do a brilliant job in identifying these themes and sectors. But something like what happened with the tariffs, and we see how these companies fell yesterday and day before, doesn't mean that they'll not grow. It just means that the uncertainty for the space increases. So again, becomes very challenging for us when these guys are supplying all over the world. We saw a similar cycle with what happened to most of the large cap generic pharma companies when the US FDA had, for a period of 3 to 4 years, continuously rejected or gave a lot of warning letters to a lot of Indian facilities, and this whole sector went through its own turmoil. So, and these are something beyond our own control. So, as of today, in today's time, try to focus on things that you know uh, remain in our control in terms of as an economy, as a company, as a business, as a segment. Where companies where they have a fair understanding of their own segments and sectors and don't have to rely on a US FDA for that matter. Uh, Prince again is okay. Shaurya said, "What is your view on Zentech? They have guided for strong growth." Uh, I think in these companies you have to more than what growth they are guiding, you have to track the order book growth because without order book growth, they'll not be able to achieve these numbers, or because they are guiding, they'll have to do something silly to get to those numbers. Sometimes management go overboard, give strong claims, and I'm not talking about Zentech here, I'm talking in general. And what happens is to meet those growth targets that they've given to the market continuously over a lot of channels, they try to do something silly, whether they acquire something or they say sell small piece of their own business. So be careful. Just monitor one, the order book growth, and of course the valuation for that. What is the for all those still present, please tame down your exit valuation multiples. We used to ourselves look at a lot of company and say we'll exit at 30x. Now we believe we have moved that to 25 20x. So because if because we've discounted our exit multiples by a huge margin, it's very important to discount your entry multiple as well. So Vince again I said our PMS is always invested in those retail spaces. Where do you see value migration now, specifically from a consumption pack? So I think we mentioned the categories. Um, Value consumption is migrating towards, say, value retail formats like, V2 retail, Style Bazaar, or I see, if you look at a Gargi, again, I'm taking smaller cap names, but larger caps are very difficult to find where, which still remain to be explored. So there's Gargi, which is seeing a huge value migration. We'll eventually have likes of Manoj Vaibhav Jewelers. Jewelry will see a huge value migration. And because we couldn't identify a single player, we've been playing this via Sky Gold, who will be supplying to most of these guys where we'll see value migration. Okay, I think those were the questions. Thank you so much for being part of this session.